Welcome to the Value Investor TV podcast. This is the podcast that helps you grow your wealth and become financially independent. My name is Becco and my partner, Hari.
Hello.
This is the second episode of Lyft. We're doing a deep dive into Lyft's financials, management, and its valuation in this episode. If you haven't checked out our previous episode 49, please do so before you come to this one. Episode 49, we talk about that's a part one of Lyft. We talk about the business itself in that podcast. So before we start, do you want to give a quick disclaimer?
Yeah, we made this podcast to educate you on how to evaluate companies for investment purposes. It is a entertainment and education purposes only. We do not give recommendations on stocks based on, for buying and selling. We want you to do your own research because we don't know your financial situation, and we're not your financial advisor. So, this is just here to help you to learn.
Yep. That's it, guys. Don't buy or sell based on what we say. We're not your advisors. Yeah. Okay, let's get going here. So we talked a lot about the business in the last episode. I think we have to really look at the numbers to truly understand the business, right?
Yep.
So let's do that. So the first question is, actually, where do you want to start? I mean, this is I don't know if the checklist itself is going to be
right
necessarily a good way to guide the discussion here.
Yeah. So I think what we're going to actually talk about here is, because I'm not really going to focus on management and valuation, because as we're going to find out when we do the financials, is this company doesn't make any money. So, but what is interesting about this is, we did several episodes on evaluating the income statement, the balance sheet, and the cash flow statement, and I want to actually talk about those in regard to this, because one of the things that is very easy to understand in like a retail company or something like that, like let's say we talked about Skechers in a previous episode. What is revenue? What is cost of goods sold? What is operating income, and so on, right? When we just go down the list, Lyft is a little bit different, right? Because they're an app that is, providing this quote unquote ride sharing, right? Well, what is involved in actually the cost of revenue, right? Because if it's an app, isn't it just developing the app, right? Well, that's not true, right? Most of the time, revenue that they recognize is not the same as the recognized revenue that they see on the income statement, right? So let's talk about that first. So you came to to the podcast this morning in a Lyft, right?
Yep.
So let's say you paid $10. Right?
I did.
Okay, so it was $10. So Lyft keeps about 28% of 25 roughly percent of that. Right, and then the other 75% goes to the driver, right? So they've raised that rate from like 15% to it's progressively gone up to 20
for themselves.
Yeah, for themselves. Their cut.
Yeah.
Right, so the cut that they keep is actually what is their top line revenue.
Mm-hmm.
So they call gross bookings. That was $8 billion in 2018, but their revenue that they reported is 2.1 billion.
Yeah.
Right. So two numbers there. Don't get confused by the gross and the net revenue, right?
Yeah.
So that once they pay out to their to the driver, what they keep is the net revenue, right?
So about 20%,
25% or so,
yeah.
Right? And they raised their rates in 2018, I think in anticipation of trying to get closer to profitability, right? But as we talked about in the last episode, if they take too much from the drivers, a lot of the drivers quit when they raise the rates.
Yeah.
And so if you just keep trying to do that, you're going to eventually, irritate all the drivers, right? So the only thing you can do, they have to try and raise their cut is raise prices or raise the percentage they keep, right? And so they've done the raising the percent they keep. Well, and so what they do next is, I'm reading down the 2018 financials, $2.1 billion in revenue. Their cost of revenue is $1.2 billion.
Yep.
And then they have operations and support is $330 million. Research and development, which is $300 million, and then sales and marketing, $800 million. these are all expenses. General and administrative, $447 million. So their total expenses is $3.1 billion.
Yeah.
So again, the top line revenue, $2.1 billion. Total expenses, $3.1 billion. So they're losing about $900 million a year.
Yeah,
right?
970 billion. Yeah, pretty much.
At the time of their IPO, and Uber will blow through this pretty quickly, they are the largest losing making company when at the time of their IPO, right? In the history of the stock market.
Yeah, that's
a dubious distinction.
Reiterate that for our listeners, because I think that's a major statement.
Yeah, they are the largest loss making on an absolute basis in the history of the stock market IPO.
Yeah, that's pretty astounding.
Yeah, so that is not a good thing, right?
That is definitely not a good thing.
Yeah, setting money on fire is not the right thing the way to look at yourselves. Yeah. But I'm not like, let's not focus on the numbers as much, but let's actually focus on the footnotes that come with this, right?
Interesting.
Because the footnotes are what's going to tell us what does cost of revenue mean, right? Because I'm looking at this and I'm saying cost of revenue, operations and support, R&D, sales and marketing, and general and administrative, right? They have these categories, and I can kind of guess what general and administrative is, because that's what it always is the people who work in the corporate office, right? And
salaries and things like that.
Corporate office, and then working to maintain the affairs of the business, right?
Yep.
Research and development, they talked about the autonomous vehicles. Yep. Not a problem, right? But these first two, cost of revenue and operations and support, is where I think this is a very interesting company, because I think not interesting company. This is where things can get very interesting for them in terms of cash flow and so forth, right? Mm-hmm. So the cost of revenue is defined as the insurance costs for ride sharing, city regulations and fees, payment processing charges, which would be like MasterCard, American Express takes, cut. The hosting and platform technology, so just actually
AWS.
Servers. Or servers, EC2. I don't know if they use Amazon or if they use something else. Okay, so So Amazon, and then amortization of technology, which is like nothing, because they bought Lyft, or one of these
smaller
scooter companies.
Oh yeah.
So that's part of their cost of revenue, right? So I want you to remember this one about insurance, because I think this is where things will become very interesting for them in the future. And if I am somebody who's monitoring this company for things, this is the number where I think they can cheat a little bit, right? Because they're using their insurance costs to effectively say it's a non-cash expense, right? You take the ride with somebody, they pay you money. They're not paying out their claim like the instant that happens, right? What they're doing is they're pooling their money, and then somebody at some time can come and say, hey, I got into a fender bender with one of a Lyft driver. You owe me money, right? And so they won't sue the driver, they'll sue Lyft, right? Because they're driving under the Lyft, banner, right? But there's also other things like they harass one of the riders, right? Or one of the drivers assaults someone, right? Which has happened to Uber. And if it can happen to Uber, why wouldn't it happen to Lyft, right?
Sure.
It's just a numbers game, the way that works. So they're basically paying out insurance. And we'll talk about that insurance here up front, later, because insurance is one of those things where you prepay for something that you receive later, right?
Yeah, the idea of float.
Right.
Yeah.
So if I'm an insurer, right, I'm sending that money away and then it disappears, right? So Lyft thinks about this as a opportunity where they can, keep this money and do something with it, right? And so what they will do is they do have third-party insurance, but they also self-insure that. Yeah. So they're basically setting aside some money for paying out future claims, right? And they record that as a liability on their balance sheet. Mm-hmm. So let's keep going down the list here. Operations and support. So they have a local operation center in every area, so that they can answer 24/7 help for riders, for drivers, fixing problems. Oh, my driver never showed up. You're not going to charge me. We'll take care of it. Or whatever, right? they do the driver background checks, and then they also take on that's the onboarding costs for doing drivers, right? Getting them ready and processed into the system, training them, whatever they have to do. So one of the things that's interesting about that onboarding process, right? And this is $330 million. So it's the total revenue was about $2.1 billion. So like around 15%, right, of the company. Or of the price, right? So the cost of revenue $1.2 billion,
Yep.
and operations and support was $330 million.
Yep.
So right there, you're at around 16.
Yeah, 16, 15, 16.
Yeah.
Yeah.
So
16.
Yeah, so 1.6 billion. So that means that you have around 500 million left to play with, right? So when you look at the rest of the balance sheet, or the income statement rather, 300 million in R&D, 800 million in sales and marketing, 447 in general and administrative, right? But again, they only had 500 million after these first two line items, right? So all of these expenses are where sales and marketing. So let me just tell you what's in what they call that. Research and development is personnel and facility. So they're employees and the autonomous vehicle building process. Sales and marketing is ads, rider incentives, and refunds. So like you rode, but and so they don't lose your business in the future. They give you a refund that falls under this. Driver and rider referrals. Like, so if you ride with Lyft and you tell your friend and they sign up, they give you a bonus, right? So
general.
Yeah. So general and administrative is insurance that is not required by the city, right? So this is
interesting.
A different type of insurance cover, right? So insurance that is, and then professional services fees, right? So what I find interesting about this whole process, right, is they're running a lot of income through that, through the income statement that are non-cash expenses, right? So why don't let's move on to this cash flow?
Sure.
Or do you have any questions first off before I,
No, I think I'm interested to figure out exactly what it looks like in cash. So let's move on.
Okay. So we remember income statement is accrual-based accounting, and cash flow is cash-based accounting. So basically, if you run a register, what does it look like? Okay, so we're taking the net loss from the income statement and we put it into the cash flow from operations. So that's negative $900 million for 2018. Their depreciation and amortization is basically nothing. They don't have much in hard assets that they can depreciate. And actually, I think it's all amortization of the technology. So tiny amount. Stock compensation, technology amortization. But here's where it becomes interesting. They have a $433 million expense related to insurance reserves. So that is a positive effect on their cash flow. So that $900 million loss, they add $400 million back into it, right? And they also have this thing called accrued other liabilities, which is like $300 million, right? So they're adding back around $700 million in non-cash expenses, right?
So let me just summarize it for our listeners here. And so in 2018, Lyft lost, again, this is in the income statement, lost $911 million. Right. $911 million lost in the income statement. When you look at the cash flow statement, what happens is that $911 million that you lost now suddenly becomes $280 million. It just jumps down because you're adding back non-cash expenses such as the insurance services, accrued other liabilities.
Right.
Yeah.
So when you look at that, you could foresee a path to being positive cash flow because they are taking that insurance reserve and just basically putting it in the bank, right? Calling it a liability, which it is, right? Because that, somebody can sue them 3 years later saying, the driver did something or whatever, right? So they have an expense that they're keeping. Now, what can they do with that?
Yeah.
Right?
Yeah.
So when we look at their cash flow from investing activities, right, which is down down below that, they are purchase of marketable securities, negative $5 billion, right?
Whoa.
So that means that basically they're buying short-term bonds, and then they mature, and then they're, and what you'll see is proceeds from sales of marketable securities, $900 million, proceeds from maturities of marketable securities, $3.8 billion. Right, so they have around $2.5 something billion in cash, right? But they're basically taking all of this money and then just shoving it into a bond, right?
Yeah.
So what does this sound like to you?
I mean, it's an insurance, right?
Yeah, it's an insurance company.
It's an insurance business,
right? So they're basically running an insurance business.
Let's look at their balance sheet.
So, I want to read from the insurance reserves.
Yeah, sure.
Right. What they qualify as insurance reserves, because I think this is kind of telling, right? Mm-hmm. Wholly owned and third-party insurance liability reflects estimated ultimate cost for claims. So those are claims that are have been insured but not paid, and claims that are insured but not reported yet. So those are things that are basically things that could come in the future. So they're putting this aside as a liability claim, and that may take several years to settle, right?
Sure.
In the meantime, they have a float,
yeah.
Right? So what their float is basically, a float is in insurance terms are, you get money paid up front, you have some percentage that have to be paid out in claims. In the meantime, you can take that money and invest it in a bond or something like that.
Yeah.
So when you look at it, they, so claims may occur in future years, and since October 2015, they've elected to reinsure all of their own financial risk.
Wow.
Okay, so what this sounds like to me is they're not a ride-sharing company at all, right? They're basically an insurance float.
Yeah, I mean,
or eventually could become that.
Yeah.
Right.
What's interesting to me is to support. I mean, when you look at the numbers, right? It's so striking that you are building. You have all this infrastructure. Insurance basically to support what's so tiny and minuscule. And so it's interesting to see the size of this insurance operation, the length to which people have to go, this company Lyft has to go in terms of insurance to support this application.
Right.
It's really interesting.
So why this is, we started out looking at this as like, haha, they lose a lot of money, right? They do lose a lot of money. But their losses are not really what that $900 million loss is not really the same thing that you're looking at right now. One of the things about insurance is you may estimate something as your future claims, right? Sure. They also make the statement, we've only been doing this for a short amount of time, so we don't have enough history to know, are we reserving the right amount? Are we reserving too much? Are we reserving too little?
Yeah.
And these future liabilities may come out and get us, right? So this is the problem that I have with this business is I don't understand, are they insuring properly? Are they underinsuring? Are they overinsuring, right? Because an overinsurance leads to, they're setting aside too much money, right? And then they can't use that effectively. I mean, it's not that terrible, but underinsurance would be potentially catastrophic. Right?
Yeah.
And especially now that they're reinsuring themselves. Since 2015, they've been reinsuring.
So that's pretty crazy. That not only have insurance, but they're also reinsuring themselves, huh?
Right. I think what they're...
With a third party or...
I think what they're doing is their primary insurance is third party and themselves. And then they're taking out reinsurance by themselves as a... So I'm not going to have to pay out the small claims. I'm going to only have to pay out the claims that exceed whatever my insurance carrier doesn't provide, right? So where I see this going is, first of all, I don't like businesses like this because there's a smokescreen here, kind of, right? Where, we're a ride-sharing business, but what we really make money off of is actually taking the money and just putting it into a short-term, thing. They can cut their sales and marketing costs and other stuff to get themselves below this threshold where they would be cash flow break even.
Yeah.
But I'm not sure if, what happens in recessionary environments. You have a very thin kind of margin,
on the float or...
Well, on a lot of things here, right? Because first of all, you try and raise prices, you wipe out your
drivers,
the number of drivers and or riders, right? You run into a recession and people are going to use less, right, of your service. They have a war chest, right? They've built up an enormous war chest so that they can operate for a very long time with, right? But they will truly never make a lot of money. And, when you look at it, how they're presenting themselves, they're not presenting themselves as a insurance business, which would change the way that they, they would basically report as top line premiums, right? That's how an insurance company
that's
files.
Interesting.
So what you're seeing here is a cash flow and income statement, kind of
it is. It's really interesting.
Discrepancy, right? It's not a normal, like, you have to evaluate this very differently than you would say if this were purely an app that just,
Yeah.
So anyway,
it's really interesting. Like, for example, for my ride that I just took to come here, $10, right? You said 25%, for example, just taken out. So that 25%, so $2.50.
Right.
That's going into, obviously, the operation of the company, but a big part of that is also going to insurance.
Right.
Reserve.
Right.
It's interesting. It's interesting.
Yeah. We don't have a whole lot more to talk about with these guys because at this point, in the checklist, I'm still scratching my head. Like, I need to see more data. Obviously, an IPO, they're not giving us a whole lot to work with.
Yeah.
But I find this is a very kind of interesting way of evaluating this, is that you're going to run into, the more of these companies you look at, the more you're going to see different kind of business models, right? Yeah. And these business models, like when we looked at NVR and we looked at Skechers, they're really very straightforward, right? The NVR annual report is like less than 100 pages. There's not a whole lot to it. It's very straightforward in what it says, how the company operates, the financial statements, their footnotes. There's not a lot of magic to it, right?
Sure.
Those are the great businesses that I love, right? Yeah. Because they're really easy to understand, right? The problem that I see is trying to understand a business like this where they operate really in two different spaces. Mm-hmm. It's a little hard to see what they're doing, right? Mm. So anyway, that's kind of where I see that. Right?
Yeah. It's incredibly, for me, it just is very, like you said, it's very hard to distinguish, like, kind of what kind of framework I need to evaluate this company with. Like you have the tech component, the app component, and you have the self-driving component, and you have the, all of a sudden you have the insurance business, baked in here. So which is all very, it's all very interesting when you combine them all like this in Lyft.
Right. And I think one thing that to think about is, what if they were an insurance company, purely, or if they reported that, would they be profitable, right?
Yeah, that's
on a GAAP accounting basis.
Yeah.
And I don't know enough about insurance to say that. I think they would be, because the premiums would be their top line, right? Obviously, they are providing another service, so they can't legally, I don't think they could report it that way. So that's why when we look at the cash flow statement and we're seeing a $700 million difference between what the cash flow statement says and what the income statement says. Yeah. So there's a big difference there, right?
There is a big difference. Yeah.
But the thing that is the elephant in the room is these are non-cash liabilities, right? The city is making them take out an enormous, because we saw that there was two types of insurance that they have. One that falls in the cost of revenue, and the other is the insurance not required by the city, right? So that may be director and officer insurance. There's, other things in here, right?
Yeah.
Anyway, all I'm trying to get at is, coming into this, I thought, okay, this is a straightforward business. Well, what does this cost of revenue mean, right? Because I read the financial statements, looked at it, and I was like, why is it so expensive for them to operate this thing? And now I look at it and I say, oh, well, 400 of that 1.2 billion is insurances, insurance expense, right? And so then you start really paying attention to that. And that's why I think this is valuable to read, not because you would invest in them, but to understand how this business works is is different than what you would normally see.
Yeah, for
right?
sure. I think there's a lot of benefit to trying to like just sit down and trying to dissect these businesses that are hard to understand. I think for me, a foray into that was, like Voya, for example, was one of those for me. Just on a personal growth level, if you find a company that's easy to understand, go through that phase, and then to really elevate your understanding of finance and business, you need to really sit down and understand like hard to understand businesses. And I think that's when you really start to put pieces together.
Yeah, and that doesn't necessarily mean that you invest in hard to understand businesses, but you expand your circle of competence, and then that makes you more attuned to what's going on. Right? This is a very interesting business for different reasons than I would have expected.
Yeah,
right?
For sure.
So that was all I was trying to really illustrate with this company.
Yeah. So I think, like you said, the management and the valuation, we're going to go ahead and skip that for this one. But I think what could be interesting, I think if we can allocate a little bit time, just a few minutes to kind of think about, if you're running this company, like what is running through your mind now? Like, now that you've IPO'd, now you're going to get public scrutiny. You're under this incredible pressure to make this company profitable. Having read the annual report, knowing all these information about the company, what would you do? What are some of the ideas that is running through your head?
I think clearly right now they are concerned about what Uber is going to do, right? Because I think Uber in their mind is the 800-pound gorilla, right? And I think what Uber is going to say is, we're going to aggressively fight for market share, from Lyft. And so Lyft is trying to figure out how are we going to make money when there's this constant fight between each other, right? So I think they're going to try and grow the ridership as much as possible, right? And I don't know that's the best strategy.
Yeah.
Like,
it's really interesting that you said that, because yesterday I just got like 50% off coupons for like 10 rides or something like that.
Yeah. Oh yeah. They're the heavy promotion, I think, is what they're going to continue to subsidize it. I mean, $800 million in sales and marketing expense, right? I mean, that's
for 200 or 2 million,
$2 billion company, So, I mean, that's a huge, like if we took that out on a GAAP accounting basis, they would be losing $100 million, right? So, I mean, there's still a lot of expenses that they need to fix, right? The insurance thing makes it, they have accrued liabilities that they can kind of get rid of, right? But, I mean, there's a lot of things in here that just make you really wonder, like, if they can't raise their prices because they operate in a commodity business, they have to cut their expenses, right? That's the only thing that they can do. And I think in their mind, if they cut expenses, people aren't going to ride as much with them, right? They're using the promotional aspect of this to make them successful, right?
Yeah. It'll be really interesting. It'll be really interesting to see this duel happen. This duel unfold as big private companies become public, and there's incredible scrutiny on both of them to really try to push towards profitability. Yeah,
no, I'm going to get some popcorn and sit and watch as these guys beat each other up, right?
Yeah. And in the meantime, use the services that they provide, because honestly, it's great.
It is a good service. I'm not going to argue with that. I think what I don't like about it is I'm not going to rely on it as in the future. Yeah. I'm going to expect that there's going to be significant changes to what they currently offer.
Sure.
Because I don't think it's going to be their vision of transforming the entire transportation market. I just don't see that happening. Yeah. So, but that's just as it stands now.
Yeah. Well, awesome. Thanks for the review. It was really insightful, Hari.
Yeah.
Any last words before we close out this podcast?
I think if you wanted to get a copy of the checklist, or you had any questions about Lyft or any of the other companies that we've talked about, send us an email at info@valueinvestor.org. We've gotten some great questions from a lot of people, and help clarify what they're thinking. If you are looking for a company that you want to talk about, or have us talk about, send us a line. Would be happy to review it. We can't guarantee that we will, just because we don't know enough about every business, but we'll at least review it and see if we can. And then the other thing is look us up on Twitter at Value Investor TV. We are, and give us a follow and send us messages but what we do is we post news articles that we find interesting and from Wall Street Journal, Financial Times, various newspapers from around the world to kind of highlight, that, value investing is in some ways a full-time gig. That you got to constantly look for things because that's where you find, gold is, under rocks. Because if it's hidden in plain sight, or if it's out there in plain sight, most people already know about it. Right?
Yeah.
So,
exactly. Awesome. Well, thank you guys for listening. We'll see you on the next episode.
Thanks.